Okay, traders, welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, January 16th. Great to be with you guys this morning. Carlos, Eman, Christopher, Pete, Peter, Mark's in the house today. Great to see you. Aurelian, always a pleasure. Good to start things off. Holiday weekend is over. We've cleared out some of that thin holiday trading from yesterday. I didn't give an update on Sunday because things were looking quite precarious as we opened the week. The dollar loss is stretched and continued to stretch after breaking the initial monthly opening range last week. We'll talk about that. We got the euro on tap. We'll review Aussie dollar from last night and sterling, as well as sterling CAD, sterling Aussie. And I do want to circle back to the euro Aussie setup from last week. Also on the docket for today, crude. Okay, we've been watching this one major resistance confluence in crude. We highlighted it last week. It came into it, pulled off. It came into it again to start the week and pulled off yet again. So crude still testing a critical resistance level. We'll talk about that. A quick glance at Bitcoin, which is down big time. Obviously, you might be seeing the headlines today. Bitcoin prices pulling off pretty abruptly. Look, that's not a trade that I'm actively in, but certainly, a little consolidation there. It does look like we could see a larger correction to the downside before resumption. So if you're in that trade, be mindful of that. Also, a quick look at pound yen from last week and dollar yen. That's what's on my docket for today. Obviously, if you guys, as always, have any questions, trade setups you want to review, feel free at any time to throw them on the message board. I'd be more than happy to take a look for you. All right, so let's jump right in. First things first, I do want to take a quick glance at just what the DXY is doing. This is a trade that was coming in some pretty interesting levels. Here's the update from the 9th. Bring your attention, really, this is the only chart that matters, is the weekly and daily charts for the index. We came off of former slope resistance late into the close of 2018. That pulled off right back below the 2016 low week reversal close, which was 93. Key resistance into the open of the year, that held like a charm, 93.89 rather. And here's the pullback. So last week we were looking at this 91.33 level into 91.93 level. We said, look, if this breaks, it's a pretty big region of support. Obviously defines the yearly lows for 2017, the swing lows for 2016, and that Fibonacci confluence. So once 91.33 gave out, this thing just shot lower, taking out last year's low. And right now, we're trading right along this parallel. Okay, this is the 50 line of the broader pitchfork formation we've been following off the yearly highs, and should offer a little bit of a near-term rebound. That's basically the theme of the last night's update, that a lot of these dollar crosses seemed a little stretched. Now, that doesn't necessarily mean that we're looking at reversal per se, but certainly a near-term pullback within the ascent, is on tap here. I think that's what we're seeing. So, last week, again, we were just highlighting a very well-defined monthly opening range. You saw that opening range give out here on the 12th with this break clearing the yearly lows, gives us a downside bias heading into a late January close. Now, with that said, again, that median line, we're seeing a little bit of a rebound. Near-term resistance now goes back to former support, 91.01 to be exact, is the low that we made from last year. That converges on basic slope support turned resistance. That's going to be your first level of sort of initial resistance, rather, on the index. So right around 91, backed by 91.33. Again, that's last year's low day close. Bearish invalidation. So even if this thing were to rocket, I don't think you get up here. But if you do, 91.90 would be the area of which, if we broke, would certainly invalidate that, monthly opening range break. And in such a scenario, you'd basically be looking for a larger recovery in the index. As it stands, all things held constant right now, we're looking for a simple rebound off downtrend support. Inevitably, again, looking to get back in on that one. So here's what it looks like. Let me get you back to the weekly chart first. Again, just to give you that precision tag, I think this is the 38.2. Yep, this is the 38.2 line, not the 50, excuse me, of that pitchfork formation. And again, you can see, obviously, this is a weekly chart, so nothing really is going to be able to be determined by this until we close out the week either above or below that slope. As long as we stay above it, the recourse is for a near-term rebound. Now, keeping in mind that just to fill the gap, the close was 90.95. The high so far is 90.94. So we pretty much closed the gap. We'll just say that for now off a pip. But that's the focus right now. If we get a rebound, we'd be looking for resistance at one of these two levels to get back on the short side here on the index. Here's what it looks like on the daily chart. Again, a little bit more well-defined monthly opening range break, the 12th there with a very, very convincing move lower. Confluence support 91 gave out, and that's now near-term resistance. A break lower from here, the levels are as follows: 89.55. That's simply a swing high pivot from back here in 2014. And more importantly, lower down, you're looking at the 50% retracement of the entire advance off the lows that we made from 2011. And that'd get you 88.27. Now that converges on basic slope support a little bit later in the month here. So before all is said and done, the focus right now, the eminent focus is on a 90-30 into 91 level. The 70 pip range is going to be our initial weekly opening range, and we'll be looking for a break of that. Okay, near-term recovery would offer a better opportunity to get short while below 91.90, a break lower, 89.55 and 88.27. So the levels are clear. I am very hesitant in these market conditions when we're coming off the back of a tail thin holiday weekend like this. I want to kind of see full market participation start to come into the fold here so we can get a little bit more clarity on price. But as it stands, those are the levels to keep in mind. Here's what it looks like on the near-term chart. Okay, so here's your yearly open. Really nice monthly opening range. Monthly opening range breaks to the downside. Look for a late month low. Again, near-term resistance 91 and 91.33. Both areas of levels for near-term, areas of interest for levels of near-term exhaustion. Okay, any questions here on the dollar index? Pretty clean as far as the levels are concerned. No real changes to our outlook on that. Certainly, we were looking for a little bit more of recovery to get us a better entry, but obviously that's hindsight. So at this point, you got to respect this near-term support. We're looking for a fizzle out on this rebound in the index. So where does that put us on some more of the majors as we stand right now? Here's what the euro looks like. So let me number 2 on the session. Here's euro dollar. So again, from the standpoint of the weekly charts on the euro, and this is something that we highlighted in last night's update. Okay, we're testing a breach of long-term upslope support. So what does that mean for us? Well, a couple of different things. Looking at this objectively from the daily chart and the monthly chart, or the weekly charts rather, you can see that if we were to close the week above this slope, that would suggest an accelerated upside bias. Right? What do we always say? A topside breach of an ascending formation sometimes will be the steepest part of the rally. The downside break of a descending formation can sometimes be the steepest part of the decline. So really the emphasis here is on the weekly close. Note that weekly momentum is right at 70. So if we're going to see a little resistance pop, push lower off momentum, this is where you'd expect it. And we have to revisit this again as we get closer to the week. But certainly if we close the week above that slope, would keep the long side bias and tap your next topside objectives. We just missed it on this stretch. The 2008 low comes in at 123.29. Major topside resistance level beyond that, there's really nothing until like 25.98, basically just shy of 26. You're looking at basic slope resistance dating off 2008 highs and a basic 618 extension, or retracement rather, of the decline from the 2014 highs. So keep this in your focus as we get deeper into the close of the week. The daily charts look like this. Okay, you did see last week yesterday we popped through and closed above that trendline resistance. Now you're seeing that that's offering some near-term support. Look, as I said yesterday, I wouldn't be surprised if this thing pulls down deeper into 2167, even 2125. That's my near-term bullish inval. As long as you stay northbound of 2125, I do think you need to respect a pullback here just within the confines of the uptrend to get back in. So right now, the immediate threat is for a little bit of a slope lower. Eventually, looking for support at one of these two levels, 2125, 2167, topside break. I do have this, which I just want to show you. I'm not really paying too much attention to it. This is a basic trendline resistance extending off the highs that we made from 2008. Now, based on whatever high you use, this is actually a 3-point touch, 1 point, 2 point, 3 point. It got a little messy here in 2014 before you broke down again. That slope comes in just ahead, okay, just ahead of the highs that we made so far. So 23 at the figure basically is where you look for the slope. And then again, 23.76 would be the next upside target on that. Here's what it looks like on the near-term charts. Daily chart, by the way, look, we see a break on the momentum signature back below 70 on a daily close basis, would again suggest risk is for near-term exhaustion to the downside before resumption of the broader uptrend. Here's what it looks like on the near-term charts, and here's what we looked like last night. The focus here was basically that we were testing near-term slope resistance. Obviously, we overshot it a little bit yesterday, but we pulled right back below and did close the session back below that slope. So, it was more of the mindset to look for near-term support, as we said, right along the 50 line, which came in. 2167 would be that first target. The 50 line's right here. 2167 here. And again, both of these levels, areas of interest for exhaustion, possible reentry back on the long side. So if you're holding short exposure, your momentum signature actually looked pretty good. You got a decent trigger earlier today. For those of you who are on our trial signals, the Euro signal short came out earlier today as well. So the break here certainly shifting some downside movements. If you're in this short, clean it up a little bit here, right around 122.10 where that 50 line is, but really 2167 is where I'd like to see a little bit more of a firmer support bounce, specifically if we get there over the next 2 days, okay, as it converges on that basic median line off the lows. So pretty interesting stuff. Again, I'll bring your attention to just the basic formation that we're looking at, this channel, okay? The upside break of an ascending channel. You're seeing the stretch higher here. This is sort of the ideal scenario of where you'd look for support on the pullback. So a little lower on Euro, I think, as we head into the US session. But at the end of the day, if we clear 123, 122.97 to be exact on the upside, 123.76 shouldn't be too far off. Okay, I think that you get that pretty quick. Hey D, Happy New Year to you as well. Great to see you in the room. Excuse me, in the room, as always. Tom, Gary, great to see you guys as well. So any questions on the Euro or where we stand on this? As far as event risk is concerned, you do get some industrial production numbers here in the United States later today, as well as dairy auctions, something that you might want to keep an eye out if you are watching Kiwi. But we also have some central bank rhetoric on tap this week, specifically today from the SNB. You got Thomas Jordan who will be speaking, but more importantly, tomorrow you do get some Fed speakers, Evans, Kaplan, Mester, all Fed speakers on tap tomorrow. I did get a note earlier today from Prattle, which is a affiliate that we have who specializes in central bank rhetoric. I just want to read the note they sent because I think it was pretty interesting. The note reads as follows. Forecast, Federal Reserve speech is likely to continue sounding somewhat hawkish. Fed policymakers remain active this week with 3 speeches scheduled. The speeches by Kaplan and Mester are likely to sound hawkish as underlying economic fundamentals remain solid. Specifically, the GDP forecast is getting a slight boost from the recent tax cuts, while the labor market continues to show strength. And in spite of low wage growth, inflation is gradually rising. Charlie Evans may take a less sanguine view of the U.S. economy, but the message is unlikely to drive sentiment away from the hawkish territory. As the Fed heads towards the transition of power from Yellen to Powell, it looks fairly clear that policymakers intend to continue the current rate path with several rate hikes in 2018, the first of which is likely to come at Powell's very first policy meeting as chairman in March. So just a quick note there, the basic markets or the basic theme here, the basic consensus is that we will get the first hike on Powell's inauguratory meeting, which will be back in March or will be in March next month. And watch these Fed speakers to possibly offer some more rebound in the dollar that we've been seeing. So obviously the index came off a big level here from a slope standpoint. And if we do get some of that hawkish rhetoric over the next couple of days, it might offer a little bit more of that upswing in the index before we start to move lower again. So that would put our play specifically here in the Euro with a little bit more of a move lower before we pop higher as a target for possibly fading a move lower here in the Euro. All right, so a lot of moving pieces here, but long story short, Euro is broken. Weekly or the monthly, excuse me, opening range to the upside to start off the week. We're coming off resistance. We're essentially looking for this pullback to offer some better entries back on the long side for the euro. Any questions on euro dollar or where we stand here? And confluence now comes in at 2145 actually. So we move forward to break down both of these levels. Look for possible exhaustion, possible support. Okay, so that is euro. We're making good time today. That's number 2. Number 3 from yesterday is Aussie, another one that looked a little stretched. So for the euro levels, guys, no change to any of the levels. We've pulled back into the 50 line here. We're sitting there right now, seeing a little bit of a bounce, but I still think you get a move lower, not down near 2167 as the initial level here for support. Yesterday's sterling or Aussie update. Here's what the Aussie dollar looks like. And from the weekly charts, you don't necessarily have anything of eminent concern here as far as resistance. Recall that 80.59 is the high day close, or excuse me, the high week close as well for 2017 in the Aussie. So you still have a little bit more room to the upside before to get too concerned, at least from the weekly standpoint. Last week's close above the 200 long running moving average certainly does bode well for price action. But again, near term, you're looking at a possible exhaustion trade here after 5 consecutive weeks of advances. Here's what it looks like on the daily chart. 786 retracement just off of last year's high gives you 79.91 as a level of interest for some possible exhaustion. The trade remains constructive above 78.86, 78.75. Key support, former trendline resistance, a nice fib confluence there with some swing highs. So even if we were to get a steeper pullback in Aussie, that's sort of where I'd be looking for support, possible reentry. Here's what it looks like on the intraday charts. Just basic stuff, guys. Channel support, 1 touch, 2 touch, 3 touch gives us a confirmed trendline support. Take a parallel off that, extending off the highs. You have a 1 touch, 2 touch, 3 touch, and that level converges right up on that 786 retracement. So either way you look at it, 79.85, 79.91. Big area of resistance here near term for Aussie dollar. Here's what it looks like on the intraday charts now. So you're seeing that price is turning just ahead of that key region. Okay. Aussie does this, remember, last year into the close of the year. We were looking for that last spout higher. It turned just ahead before actually continuing higher afterwards anyway. So this could be a shorter-lived pullback, in my humble opinion. Remember the upside break of the ascending formation, again, being the steepest part of the rally here so far. So it could get a little bit of interruption here. Near-term support, a couple of things I'm looking at. First of all, you have this basic slope parallel here in this dotted red line. This is the same slope as this pitchfork. So you can see the median line offering a break, acceleration, support again at the median line, support again at the median line. We broke the resistance, acted as support. We pivoted on both sides of it, support again. That converges right around here. 78.86, 78.97. That converges on the near-term embedded channel too in red. And that's basically support. I mean, I'd want to see price stay above that region for this immediate upslope, immediate advance to have more legs. As it stands right now, again, you're coming back from overbought condition. You haven't necessarily seen a trigger break yet, so I wouldn't, necessarily get encouraged on getting too bearish on this just yet. But certainly, if we were to break back below that trigger, specifically break back below this trend line, I would expect a deeper pullback towards that 78.86 level, maybe even deeper towards that blue line. But basically, this is the region of which you want to look for possible reentries for support on Aussie. Okay, keeping in mind the weekly open comes in right here at 79.37. Oh, at 79.01, excuse me, that's the weekly open. So as we get into the 79 handle, just below, if Aussie dips, look for exhaustion, look for momentum to really get a little bit more of a turn. And again, an area of interest of which we'd like to initiate some long positions if reached. Any questions on Aussie? All these things look a little stretched. Daily chart still has us in overbought condition. So obviously, any pullback that you play or any shorts that you take on Aussie guys, a quarter leverage, if not half, because we're playing counter trend. Ideally, you wait for the pullback instead of playing that pullback, looking to get back on the long side. If you're nimble enough, you see this thing start to slip below that trend line in red. Again, it might be worth a little bit of a quick scalp to the downside here. But long story short, you're just at risk as you head into uptrend resistance. Okay, a little precarious here. Is the dollar showing a little bit of a rebound off support, putting all these trades on the dollar, the euro, and the Aussie specifically in more of a pullback stance. Same thing with the Aussie. This is number 4. Or excuse me, with the pound. This is number 4. Here's what pound looks like from last night. So by the way, so on the Aussie, okay, we're just at resistance. We're turning ahead of resistance. And the threat is for this immediate advance to fizzle out ahead of this 79.91 level for a little bit of a pullback. Okay, any questions on Aussie before we move on? Next up on tap is pound. And for pound, there's very compelling reasons to be concerned about the long side. Again, let me take this back. Don't stress that we're necessarily working on the possible 5th week of consecutive advances, because that's not all out the realm of sort of extremes for sterling. The point being that the near-term approach is testing not only structural or slope resistance, but also horizontal levels of interest from a Fibonacci standpoint. You have the 618 retracement, comes in at 38.43. You have the 100% near-term extension off the advance, that gives you 138.09. And just higher, I left it here on the intraday charts, the measured move for the consolidation triangle breakout that we had all throughout the month of December. That measured move, the 100% extension, actually comes out just higher, 38.78. So between 138.10 and 138.78, sterling is littered with resistance. I'm bullish sterling long term. I do like the broader picture, still tilted to the upside on British pound. Immediately, that advance is at risk while below 39, specifically 38.78. Here's what pound looks like today. Okay. Well, first of all, I'll bring you to the weekly charts on the pound just to show you again the advance that we've been tracking since last year has been spot on. This thing has been holding sterling price action for well over a year at this point. The median line, the objective 50 line of that pitchfork, okay, comes in basically just beyond the highs that we made today. So it leaves a little more room to the upside. Confluence resistance doesn't come until later, okay, basically into the close of this month, open of next month at 38.2. That gives you 39.52. Immediately, the focus is on the median line, just higher. So that's the weekly chart, just to give you a broader picture from 1,000 feet up of where sterling is playing off of. We broke over trend line resistance, extending off the highs from 2014. We even tested that again here, broke above it, tested it as support, and moved off. So the focus here is for this advance to fizzle out as we get into this region. Look to use that pullback to get a better entry for a resumption of the broader uptrend. So the sterling weekly chart, still pretty clean. Momentum profile remains rather healthy. Nothing to get too concerned about. Daily chart, well, there's that Fibonacci confluence resistance that you're looking at, okay? Again, that same median line leaves a little room for an advance just a bit higher, near 38.60 basically, right? Ahead of 38.60, 38.45 is that long-term 618 from the Brexit decline. That's literally from the 2016 highs all the way to the decline from last year. Okay, so you're basically taking into account the entire Brexit decline. 618 comes in with former swing lows. It's the opening range low for 2016. And again, that median line. Okay, so 38.09 to 38.43 on the daily chart, just higher, that median line area of serious inflection. So what do I mean by that? Well, it could charge a pretty decent pullback. Ideally, you guys know we've been bullish sterling forever. It's about picking and choosing your entries. So if we get a decent pullback, we'll look for reentry north of the monthly opening range, which obviously broke very clearly and definitively here on the 12th. Should have us looking for a late month high. But the initial immediate advance is at risk here. Okay, even looking at this from the momentum profile, you had a 3-point support trigger which gave out. That gave us the spill into the December lows. That same trigger line in momentum on the daily chart has been resistance on the way up, and again, resistance yet again on the way up. So slope, even in the momentum profile, offering some tell here in sterling. Quick reminder, I do see some new names here in the room. Welcome aboard. Remember that you always have that camera button in the middle of your GoToWebinar screen. So if you ever need to take a snap of any of the charts, excuse me, of the charts that we were presenting, feel free to click on that button so you can refer to it at future reference. But as far as the sterling is concerned, no change to any of the levels presented last night. The focus right now is on this key resistance region. Now, intraday chart, again, no change to this. Same thing here. We're basically looking for exhaustion. We're getting that pullback now. Don't chase from here if you're not already short. If you get another stab into this region, specifically if you get some divergence on another move into this region, I would once again be looking for exhaustion on a stretch into these key zone targets. Okay, ultimately, I'm looking for a move back into this big region. It's where we caught the high last year. This is the Brexit gap, which we just missed last year. Obviously, we filled it on this stretch. That gives you 36.65 into 36.75 as near-term support. Okay, again, just basic channel, guys. Basic channel, 1 touch, 2 touch, 3 touch. Take a parallel of that, extend it off the highs. That same slope converges on that same key region we just talked about. Okay, so sterling really looking precarious here for some weakness, sub 38.78. Ultimately, well above 36.58, we do want to be looking for an entry again back on the long side for pound. I know Jamie's entry, by the way, for the swing side of trades is right in this pivot zone. Jamie's entry is 36.60. So for the swing side of trades, also makes sense to come into this key pivot, look for the re-entry, and then again, ultimately we are looking for a topside break of that resistance confluence. And although some people might think this is way too premature, honestly, guys, a topside break of this region is really nothing to stop sterling from going well north of 141. Okay, but first things first, got to get through this 38.70, 38.40 region of resistance. Any questions on the British pound? As far as the BOE did have some comments yesterday. The BOE policymakers to speak in 2018 will be the newest member of the MPC, who is scheduled to speak on Monday, so we already got that. Comes to the BOE with previous experience at the Federal Reserve Bank of Boston. They're talking about Silvana Tenrio. Because there's no previous BOE data on Tenrio's speaking style from which to establish a baseline, we cannot forecast the score of her speech or create momentum reading. However, profile of her suggests dovish tendencies. Regardless of how the speech scores, it's unlikely to cause a significant deviation from the BOE's somewhat dovish position. If rumors of a soft Brexit continue to cause sterling strength, stagflation pressures may subside in the UK and provide a bit of a breathing room for the MPC next year. So another note there on BOE members who are expected to be a little bit more dovish as it stands right now. Still concerns over whether the Brexit talks will result in a more soft Brexit outcome, as they call it, which is, i.e. a little bit more orderly type of divorce proceeding. And I think that's what the markets have really been buoyed on this entire time with this rally in sterling, is that the Brexit is not going to be the disaster end all sort of catastrophe that everyone's calling for. And price is saying the same. Price speaks, we gotta listen. Any questions on sterling? Minor setback here at risk while below 138.78. Topside breach. Ultimately looking for 141. That is number 4 on the session. I do want to take a segue and go into some of the sterling crosses that we've been following. So this is sterling dollar. Last night I also gave you an update on sterling CAD. So for sterling CAD, this was the only pound cross. Remember last week we were talking about the pound, which was getting hammered. And this was the only one that looked supportive. And sterling, was really kept afloat by some of the accelerated losses that we're seeing or some of the accelerated, rather, losses that we were seeing in CAD, right? Dollar CAD saw a nice bounce. That's CAD weakness. CAD weakness, despite the sterling losses that we were seeing last week, still outpaced the sterling. So that gave us an upside bias in sterling CAD. Now, the last target that we were looking for was basically a breach above 70.84 for a tell. Once we got that 70.84 for a tell, it kind of just ripped higher. Here's sterling CAD now. Okay, there's 70.84. You saw the rip. It turned just ahead of the 618, and here we are right back at support. So as I noted yesterday, I wouldn't be surprised to see this thing sink as low as 70.28 again. That's going to be our near-term bullish inval area of interest for me, that I'd be looking for a possible rebound in price. But certainly, if this break of the broader descending slope we've been working off from the December, this is actually the November highs, you'd think you'd get a little bit more juice to the upside. So I'm hunting for long entries on this decline. A dip into 70.28, in my humble opinion, would give us an opportunity to look for some exhaustion. Bullish inval. The only thing that would put me straight bearish again would be if we break back below the upper parallel. Aside from the pitchfork, guys, this is basic trendline resistance off the highs. 1 touch, 2 touch, 3 touch, 4 touch. The break, fueled acceleration. So on the way down, if we were to break back below this, you'd look for a larger decline here. Not my base case scenario. Base case scenario is a little bit more of a drop. Look for entries at one of these two levels, ideally 170.30. And again, a topside break, targets unchanged. 171.95, just ahead of 172. And then the 73.15 level. I'd even bring this into the 764, take the inside target. That gives you 73, basically, 72.99. And matches pretty darn nice here with some of the swing highs they made in December. So sterling CAD, another interesting sterling cross that we've been following, but levels look pretty clean still. So no change to any of these levels. The only thing I just did was just lower that 78 target into a 764. Again, 764 is another derivation of the Fibonacci sequence, guys. It's simply 1 minus the 236 retracement. And that gives you, like I said, right on the 73 handle as your next upside target. Any questions on pound? So same thing, the theme of all these trades to start the week has been things are vulnerable. We're heading into resistance to open the week. We've got one last push higher on thin holiday trade. U.S. markets obviously were offline yesterday in observance of Martin Luther King Day here in the United States. Both equity and bond markets were closed. So as we get some of that full market participation filtering into markets, hopefully we get a little bit more clarity on some of these stretched out trades that we've been following since last week. All right, moving right along. Last but not least, from the sterling crosses, sterling Oz was another one that we talked about last week. Someone had brought this up in the webinars, and the main thing that we were talking about is that sterling was sitting versus the Aussie, at least, in this range for like 2.5, almost 3 weeks. Now, the break of that range saw a dip into a critical support confluence. We talked about 70.83 into 71.20. It's the 2017 yearly open. It's the 618 retracement of the decline that we saw back here. We left that on, although we broke the highs, we left that on just on account of the pivot in price. Okay, resistance, instant support, break saw acceleration, resistance, 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 resistance saw an instant support bounce, pivot on both sides. Now that converged on the 100-day moving average, which has been a very nice pivot in this pair. So while we broke the monthly opening range, our first level of support and our major support sort of threshold we talked about was 70.82 to 71.19. I didn't think we'd get a bounce that big. I'm not going to lie to you. Okay, we were looking for the rebound, but that rebound took out the entire monthly range and came right into the monthly opening range highs before pulling back. So the point of this trade, and the only reason that I put this on here on just a daily chart, is to focus and highlight 70.83 into 74.16. I know it's a bigger range, but Sterling Oz has a larger ATR, and that's a well-defined opening range for the month, if I may say so myself. Okay. And it's an opening range, it's a monthly opening range taking shape just above a key support confluence. So the emphasis, I don't have any plays on this right now, but the emphasis is on a break of this key range. Topside break, you have room to 76. A downside break, you're looking for that 200-day moving average and slope support. So for me, Sterling Oz, simple range as it stands right now. Here's what it looks like on the live charts. Okay, there's the monthly opening range, very clean, well defined. Here's what it looks like on the intraday charts. The levels that we've been following. Here's your yearly open right here. So look for a break of this range. If you put a gun to my head, guys, I would be looking for a move higher outside of this range with a breach to the upside. Just because of the way that we reversed off of this support is important. It's technically significant. And if you take a look at this on the weekly charts, pound Aussie, last week, what did it do? Well, it posted an outside week, reversal candle right off support, right off last year's open, which has been a very clear pivot in price, as we just said. Right? So pay attention here. Pay attention here. This outside week reversal shifts the focus to the upside. You got to get back through 76 to get this thing going. But certainly our ideal scenario here would be for this thing to find some sort of support and a move higher. And interestingly enough, you see this parallel that we've been following. If I take a parallel of that slope and I measure it up to the lows that we made there in late October, you could see that price basically rebounded off that same slope support on that outside week reversal. So it's not a very strong signal, but certainly it's something that's telling. For me, paying attention to it puts more emphasis on that initial monthly opening range break. And certainly for me, still looking for momentum. Well, momentum has been largely holding 40 here as support, but I'd still be looking for a pullback here to offer more favorable scenarios on a possible move higher. Any questions here on pound Aussie? Where we stand here now on pound Oz? All right. So that is number 5 and 6. I do want to take a quick segue. Last pound cross I had been covering was pound yen. Here's what pound yen looks like last week. For pound yen, what can I say? Where is it? Here's the last pound yen update. Okay, so we were looking at this formation. It was kind of hairy. This thing turned right ahead of a big resistance confluence I had at 154.71. That's just former swing lows, but you also had some slope up there and the immediate slope that we've been in all through that channel last year. So we turned right ahead of that. The focus of the trade that we were focusing on earlier was the possibility for this breakdown to really materialize. And a break below 149.53 would have been, all out bearish period end of conversation for pound yen. Now, we've come into this trend line here with last update that we were talking about, which could offer some resistance or some support rather, right? And we want to stay bearish while below that slope resistance that we've been following off of last year's low from that pitchfork. Well, we saw a big rebound there, and it came right back into and surpassed the monthly open. So for pound yen, I didn't give you an update on this yesterday because as of now, I kind of want to take a little bit more of a softer approach. Things that concern me. This does look like it could complete a 1, 2, 3, for kind of messy fifth wave high, which would suggest that you're at risk for a near-term correction lower. Also, where we expected to find resistance, we basically did. We basically did. Remember, we talked about that slope. We wanted to see resistance at that slope. Now, obviously, we've seen a couple of days where intraday price has spiked above, but we haven't been able to get a simple daily close. Whoops, wrong chart. We haven't been able to get a simply daily close back above that slope. So looking at this from the momentum signatures, 60, struggling to hold his resistance here, but nonetheless, the momentum signature stays subdued sub 60. And then here again, even on this last stretch, the quick recovery and pullback really puts the emphasis on a weekly opening range break. But as it stands right now, I do think you look for a recovery in pound kiwi and pound yen lower from here, at least the immediate threat for me. So no major changes to the pound yen trade, at least. As it stands right now, my focus is sort of fading near-term strength in pound yen. And specifically, if we're looking at some of the other pound crosses, guys, we talked about pound CAD being a decent trade that we're looking for support for a move higher, pound Aussie possibly as well, pound dollar checking major resistance. So maybe that pullback, again, some long positions on those crosses. Pound yen is one of the pairs that if I am holding long exposure, this is one where I wouldn't be too hesitant to try to get a little bit more of a short side play on pound yen, possibly sort of a synthetic hedge if you're holding long sterling exposure in other crosses. Okay, so that is a fair look at all the sterling crosses. I did want to cover three more things. I see your question here on Puja for euro yen. We'll definitely take a look at that. Eman, Kiwi as well. Let me just touch base real quick on these last couple of pairs. So euro Aussie was a trade that we talked about last week as well. Here we go. And here's what euro Aussie looked like. We were coming into a big support confluence. That level was defined by 52.26 into 52.61. It was the June high. You had the 100-day moving average. You had downslope support for the current operative trade that we've been in. Look how it panned out. Remember last week, guys, we were talking about pound Kiwi, right? I was looking for the same exact sort of play. Pound Kiwi did whip me out and take me out of that long position before inevitably finding support and rebounding higher. This is another fake out, okay? That key support barrier, we came right into it. We saw a rebound, and it actually looked pretty convincing that this thing, had found a support. We found a nice break in trigger momentum. It moved higher. The break lower was short-lived, and certainly when you look at this thing on a daily chart, couldn't even make a close below that 52.26 level. So while price action did dip well below, that stern recovery we made back on the 11th gave us a close back above that region, and certainly for me, gave us the risk of a rally higher near term. Now that rally coming into resistance, former support, and pulling off. Once again, and I hate to keep giving you these range trades, but once again, putting the emphasis on a clear break of the definitive monthly opening range. Okay, very, very well-defined range. So Euro Aussie, still looking for a little bit more of a tell on this one. Again, wouldn't be too surprised to see a deeper pullback here in Euro Aus, but ultimately, I am looking for a little bit more of a support bounce while above 152.60, 152.54 here. All right. Last but not least, 6, 7. Oh, that was 7. This is number 8. I do want to talk really quick about crude prices, which is, massive. You're going to keep hearing the headlines on crude just because of where we're coming off of. A lot of people have been, super bullish, which I think rightfully so. But last week we had highlighted something of very subtle interest. And that level was basically the key resistance barrier that we were coming into at 64.78. Now, taking a look at this first from 1,000 feet up, here's the weekly charts, guys. Very, very basic stuff. Basic pitchfork median line resistance off the lows from 2016, the highs from 2017, the lows from 2017 has been picture perfect. pivots all along the median line. The 50 line was resistance, was resistance, was resistance. The break saw support, support, support. On the rebound off the 50 line, there's the median line. Now that median line converges on a 100% extension from the advance off the 2016 lows. So they gave us a target of 64.78, and we've been talking about that level for weeks now. That's what a resistance is, and the immediate approach is at risk well below 64.70 for a pullback. Now, as I always say, can we play the pullback? Sure. If you're nimble enough and you're quick enough, I'm with you on it. I've been looking for short scalps within this trade. Ultimately, it's an uptrend at uptrend resistance. So the pullback should be shallow. It could be shallow. You want to be half leverage, very, very nimble. Ultimately, the pullback to be bought. But where does that leave us near term? 64.75, 64.78 is key resistance as we stand, as we open the week. Here's what we look like last week on crude prices. Last crude update was back here on the 9th. Okay, and here's what that crude chart looked like. We gave an update earlier on the 8th about that key region of resistance. Last week, we were approaching that key region of resistance. Pulled off a little bit. We stretched higher, and now we're finding resistance right here at that 76.74 level, or excuse me, 74.78 level. So let me take you back into the daily charts. Here's what the daily chart looks like. Some interesting price action on the daily chart. Not only do you have that multi-year pitchfork that we just talked about, which has median line resistance there, but an embedded basic channel resistance also included. Here's a basic channel off the October swing low back on the 9th. Take a parallel of that, extend it off the highs from here on the 8th of November. You can see that that slope converges right on the same region, right on the same region. So look, I'd be looking for an initial support, initial target if you're holding shorts near 62.56. Broader bullish invalidation, you want to stay constructive crude prices while above 60, specifically 59.94. Basic channel support and the 50 line that we were talking about on the daily charts converge right here, basically this week. So yeah, I am looking for a little bit of an exhaustion trade. Could see support here. I don't know. We'll have to see what the momentum picture looks like. But for a complete pullback within the confines of the uptrend, even a deep pull into 60 wouldn't rule out, the uptrend. We would still be looking constructive. Topside break, you're looking for right on to subsequent topside objectives at 67.14, and the 70 handle would be a 50% basic retracement of the entire decline off the highs that we made in 2011. So levels are pretty clean. Near term, look for some possible weakness here in sterling off of resistance and crude, off resistance. Keep in mind that the momentum signature from a daily standpoint still remains an overbought condition. So again, that caution, I really can't stress it enough, is well warranted at this point. Here's what it looks like on the intraday charts. Okay, so from an intraday standpoint on the 240-minute charts, again, strong divergence. As you make new highs, price action registers a new extreme in price. The oscillator does not confirm the extreme in price, and in fact, one reference point above the overbought threshold, the other reference point for divergence below the overbought threshold. Certainly suggestive that we are in store for a little bit more of a pullback play here in crude prices. Okay, that's crude. It's going to be important this week. You get inventories, obviously, again tomorrow on Wednesday, so we'll keep an eye on that. But, a lot of people have been talking about crude prices, and you're seeing headlines about the strength. These are times of, that scream exhaustion for the near-term trend. Ultimately, this thing's been performing pretty well. Remember that the major objective target for crude prices on the triangle breakout that we were following all throughout November and December, that measured move was right here at 63.23. So we broke above that, and that's actually been support ever since. So look for that as a target, 63.21. Again, 62.56, both areas of interest where it start to look for possibility of a rebound in crude prices. Broader bullish inval, still down here. Whoops, didn't mean that. Broader bullish inval, still at 60. Questions on crude, going once, going twice. 7, 8, that's number 9. And the last thing I have, just a note here, is on Bitcoin, guys. If you're trading this, let me say this: if you're looking for new long exposure, this is, I don't think, in my humble opinion, again, the time to do that. Guys who are holding longs, if you're holding anything sub 88 or 8,800, I wouldn't start running out just yet. For me, that's sort of my line in the sand. If we were to break back below that critical level, I do think there would be some more noise here in markets. But the thing that I've been looking at here in Bitcoin is just this simple consolidation range. Okay, and 1 point, 2 point, 3 point support, kind of messy, right? But the breakdown, certainly from just a basic Fibonacci standpoint, the extension of that decline actually risks a move all the way down to 87.28, which is just at that level. Again, I'm not calling for a complete washout or breakdown in Bitcoin, but that's the risk with this break here. That's the risk with this break. First things first, though, right here, 11,000, what is that? 11,282, 11,160. The swing lows that we made back here in December, 786 retracement. Yeah, sure. Could see a little bit of a rebound off this. Wouldn't even be surprised if we get back into 1,300 or 13,000. But that being said, the near-term risk for Bitcoin does remain weighted to the downside. This is not even taking into account the news, guys, of the regulatory restrictions that are coming out of South Korea and some other the Asia-Pac countries, which are sort of becoming the main story here, that we're seeing a little bit more of an interruption of possible adoption of Bitcoin. That being said, that's a whole different story, right? Just to look at price certainly leaves things vulnerable. A break below 11,282, in my humble opinion, would certainly suggest you have some serious downside to go here in Bitcoin prices. So just a quick note there. Okay. 9, that was 10. Let me take a segue into your questions. First up, Pooja, I want to take a look at Euro Yen. So Euro Yen, obviously last week, came off of a pretty big region, or turned right ahead of a pretty big region. But let's see where we are on this now. Right. So I'm not really a big fan of this pair, to be quite honest with you, Pooja. If you remember last week, once we started to break down, I was looking for a sort of bearish invalidation at the monthly open. I wanted to see price hold there as resistance for a move lower. So once we broke back above that, I'm neutral. I really don't, I'm going to be completely honest with you, Pooja. I'm not a big fan here just because the monthly opening range is massive. But aside from that, a monthly opening range is only a tool. It's like saying I can't build a house because I'm missing a screwdriver. Well, you can make do, right? There are other options that you have to get the job done. The problem here is that not only is the monthly opening range massive, but you're sitting mid-range. So I don't know what to do. You don't really have a position to trade against for the short. The high is all the way up at 136 and change. So you're looking at a 100 pip stop. With the same respect, you're sitting at monthly open support. So what do you do there? And in my humble opinion, again, Pooja, I'd be neutral here. If you put a gun to my head, I would think that Euro Yen still has a move lower first. As it stands right now, this has already completed an outside day reversal, not quite off resistance, although the high day close at this point for the year does come in right here, 35.97. That's this year's high day close. 36.23 being the low that we made back in 2014 or early 2014. But you get the picture, right? and then obviously support right back again at 134.28. So for me, the focus range is basically right here. Break below 34.30, sure. Look for resumption down towards the median line. That's what I was targeting on this break, to be quite honest with you. And interestingly enough, guys, if you remember the webinar when we were first putting this together, I think it was you, Pooja, who actually asked about it. All we did was add this. We said, you know what? The slope has been pretty clean. You got some messy breaks on both sides, but if we take a parallel of that slope to see if the slope still offers some living tell here, right? You could see support, 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 and again, that decline turned right there, okay? So I'm more inclined to focus on this slope support, which would bring this basically to a break of the monthly opening range low needed to get this thing going. So I know I'm all over the place here with this, Pooja, but just again, I'm not really a very conviction trade for me. Like I said, shotgun approach, put a gun to my temple and say, Michael Boutros, I'll blow your head off. Which way will this go? I would say look lower from here. But as far as trend resumption, I don't think we have enough data. I don't think we have enough information yet to really take a firmer stance on this. Pooja, does that make sense? Pooja says, yes, thanks. Even I was lost for direction, which is why I asked you to take a look. Yeah, well, hey, I don't blame you for asking. This is the right place, guys. I never blame anyone. Any question that you have, this is what you pay for, and that's what I'm here to provide. So I'm more than happy to take a question. And you know what? If we don't have a strong opinion on it from a technical standpoint, that's okay too. But it's better to know that we've got a little bit more of a wavering bias here until more clarity comes out, right, Pooja? So don't ever regret asking. Here, I'm always down to look at stuff that I haven't been looking at because hell, a lot of times you guys point out positions to, or opportunities that I may not have seen, and certainly that quick recap of the technicals can give us some conviction. So I don't think the conviction is here just yet. Ultimately, I do think you're at risk for a little bit more of a near-term pullback. I'll show you the intraday chart here, Pooja. The levels, like I said, aren't that clean. This is a pitchfork I was working with that I showed you guys yesterday. I was willing to forgive that break into the median line of recovery, but on the stretch, the 50 didn't really offer much, and we didn't quite make it to the upper parallel. So I'm kind of torn on this one. One pitchfork I would have also considered was this, which basically almost gave you just a lateral move. Okay. And again, even that doesn't give you guidance, at least into what near-term price action has done. So as it stands, let's clean this up a little bit. As it stands, look for immediate near-term support, possibly right here at 134.80, just below the 35 handle. A break below that would certainly validate just a basic break at the weekly opening range. And then again, you have a soft target 134.45, but then you'd be looking back for the median lines that we were talking about. So yen strength has been sort of a play, right? Obviously, we're holding dollar yen on the swing side of trades. That's been panning out really well. And for the euro, which we looked at earlier in the session, well, we're coming off of near-term resistance. So euro yen, sure, I could see a possibility we see some more downside on that, Pooja. But by far, I would not call it a conviction trade just yet. Okay. Questions, comments, concerns? Eman says, hello, Michael. Can we have a quick update on Kiwi, please? Thank you. Yeah, so Kiwi's another one very similar to Aussie, which we went over earlier in the session. Here's what Kiwi looks like. So I'll take you back to the daily chart. And for me, Kiwi is sort of, contending for the abomination title these days. Here's what Kiwi looks like on the weekly charts. So by the way, for euro yen, this is another thing, Pooja, that we'll be mindful of. 36, 32 level from a longer term standpoint, pretty big. These red lines are all slopes that were derived from the basic slope support off of the yearly lows. Okay, obviously forgiving the Brexit decline here, which we saw back in 2016. One touch, two touch, extrapolate off the high, break saw acceleration, instant support. Extrapolate this off the yearly opening range lows from 2016 on a closed basis, resistance, 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 perfect resistance confluence. So divergence all along the highs, price action making a higher high, price action making a higher high. The oscillator certainly unable to make those extremes as well. So the exhaustion trade here, in my opinion, still is kind of the focus for me in Euro Yen. But I digress. To get back to, I like the weekly resistance level, but I don't know what to make of that last week's candle with the long wick down. So Puja, very, very, very good point. I'm impressed. A lot of times, guys, or let me take this back. We'll always stress the levels here, right? That's what I always tell you. The confluence regions of both structural resistance and support and horizontal levels, whether the Fibonacci or simple pivots in price. Those tend to be big. I personally, Pooja, don't tend to put too much emphasis on a weekly candlestick formation. Don't get me wrong, they can be telling. Outside weekly reversals, so certainly dojis near resistance or support, these kinds of things can be telling. And you're absolutely right. The candle close here would suggest that the downside reversal didn't have all that much juice in it, right? But certainly the yen strength that we've seen, euro reaction that we've seen, let me say this, Pooja. I wouldn't be targeting anything on a euro yen pullback outside or below this median line. So any short exposure, last week's swing low converges right on that median line. So I wouldn't be surprised, to get a pullback in here. It still wouldn't undermine this bearish. I guess this actually looks near-term bullish. The pullback like it fizzled out, but this wouldn't necessarily undermine this candle, even if we were to stay in that range. Would still look for a possible move down near 133. Okay, Eman says bingo. Well, I hope that's a good thing. I hope that's a good bingo, Eman. But here's what Kiwi looks like. I'm over on time here, but I promise. So promise is a promise. Here's Kiwi. Okay, my problem is the 200-week long-term moving average converges just above basic 618 retracement of the entire 2017 range. Near-term exhaustion after a 5-week advance. This would be 6. 1, 2, 3, 4, 5. This would be a 6th week of consecutive advances on this one. We've been liking to bring up the consecutive bars indicator just to see, how many times we've seen 6-week advances. Remember, we did this last week. We saw that out of the last 4 times, 3 of them caught near-term highs in price. And that was after a 7-week advance. So the extreme call for some sort of turn just because of the extreme advance isn't really that paramount yet. But certainly from where price is trading, it's vulnerable. My problem is I don't have a trade setup there. I have an opinion on what I think will happen. I don't have a trade setup. Why? Because the level of which what we're turning from doesn't have all that much technical significance for me. The only thing that I was eyeing on this last night was the reversal day close from back here in September of last year. Not the high day close. The high day close comes up here, but the reversal day close, subsequent to the high, it gives you 73.06, and that's basically where this thing kind of capped out. So, gun to my head, look for a near-term pullback in Kiwi, but as far as trying to put a game planning man on it as a trade, I just don't think you have enough here. Divergence into the high in the near-term charts, great. Looks like you're pulling back. If you get a break of the month of the weekly open, I'd be looking for recovery near 71.70 again, but upside break of an ascending formation. Certainly this has been indeed the steepest part of the rally. So the theme of the day, exhaustion, stretched highs, still kind of paramount here on some of these dollar crosses, crossing over into Kiwi for sure. Keep in mind you do have dairy auctions, like I said, on tap later today. Could be a decent mover here on Kiwi, but I have nothing to do here from a trade standpoint. It's either a deeper pullback as close to 71.60 for a long position, or a break of the monthly opening range highs, the break of the weekly opening range highs, 73. A break above that, you essentially have a 100 pip run. Next topside objective target takes into 70, just shy of 74 essentially. All right. And that is Kiwi dollar. Any questions on Kiwi? Okay, guys, I am over on time. We're going to wrap things up here. We'll be back tomorrow morning, same time, same channel for another intraday strategy webinar. Take it light, guys. Market participation is just coming online here as U.S. markets come on, open up for the first time this week on the back of the holiday weekend. Really looking forward to today's close to get some more conviction on some of these stretched out trades. But we'll keep you updated on SB Squawk. Till then, best of luck trading, and I'll see you tomorrow. Cheers.